Good morning and welcome to our Roundtable series with Withum. Today's Roundtable series topic will be PPP loan forgiveness and year-end tax planning. We have joining us again today, Glenn Bellamy, partner, practice leader, consumer products of Withum, Terry Moncrief, partner at Withum, team leader, food and beverage, restaurant and bars. We have Dan Mayo, Principal National Lead for Federal Tax Policy, and Alana, their communications and just all-around best person on their team, in my opinion. Welcome, Terry.
Thank you, Shah. Thank you very much. And you'll get no argument from me that Alana's the best of our team, that's for sure. Thank you all for coming and welcome back. This is our monthly roundtable. We call it the Restaurant Roundtable. It really is just an open forum. We're hoping for a lot of interactivity. We're bringing it just to try and bring the latest and greatest in financial wherewithal and knowledge to restaurateurs. So we are available. Again, we want it to be as interactive as possible. Please ask questions. Please interrupt. I believe you can raise your hand. You can type questions in the chat box. But it really is for you guys, and it's an open forum to answer any questions you may have in any way at all, financial related or tax related or audit related. So that's kind of the game plan. We're doing it once a month, second Tuesday of every month at 10 a.m. So we hope to see you on future events. For this month, we have Dan Mayo. Dan is a principal with Withum with our National Tax Services Group. He's a really smart guy when it comes to everything tax related. So we kind of get him to deal with everything that we have as tax related items. We're going to start out today. So we have 2 or 3 specific topics we're going to speak to today. Number one is PPP forgiveness applications. We're just going to spend a little bit of time on that because we spent quite a bit of time last month, but we're going to kind of clean up and see if there are any additional questions. Then we're going to roll into a couple other areas of any potential tax law changes we may see under a Biden administration and some tax planning in general for 2020. So to get started on the PPP loan forgiveness side, we have a couple polling questions. Alana, maybe you can kind of explain how the polling works and then put up our first polling question.
Yes, so we do live polling through menti.com. So if you type in your web browser, menti.com, you can use the code 7100765. And then you can vote and we'll see the answers come up on the screen here. It is totally anonymous. And the link and the code is in the chat box. Again, it's menti.com. The code is 7100765. I'll give it about 30 more seconds. Okay, Terry, it looks like most people have not submitted.
Oh, bank approved.
It may also be some people are calling in from their phone.
Yeah, I think it takes a few minutes just to kind of get connected with Menti.
Yeah, and for the first polling question of the day, we always like to give it an extra minute or two, but I think we're just about ready. So it looks like I'm actually surprised we're not seeing more on the bank approved. Haven't heard from bank yet. I have quite a few clients who have submitted the application, heard from the bank relatively quickly and got through that approval process, but have not heard back from the SBA yet. That's where quite a few of mine sit.
One thing, Terry, if about 3 or 4 people just came on, I don't know if you want to ask them the polling question.
I think we're probably okay. We got a kind of a general idea, and we'll have more polling questions later, but as long as they kind of understand about this menti.com, go to menti.com and you'll be able to answer polling questions. So I think we're good, Alana, on this.
Okay.
Matter of fact, we don't even need to ask our second question. The second question was going to be around the timing of how long it took for the SBA to approve it. and we don't have a single SBA approval on the call, which is okay. I'm surprised we haven't seen that. I've got a couple of clients that have gotten that far through the process, some of the smaller loans.
I think it would be nice to hear from Dan to see, I know he's done hundreds of these applications. So Dan, any kind of a comment on your side about, you know, the phase that these applications are in?
Yeah, we're seeing approvals come through now. So the SBA has been approving loans. We have not seen any above 2 million, but under 2 million, we're seeing approvals come through. It's taking about 45 to 60 days is the average time period. Some longer, some shorter. I'm hearing from banks. I spoke to 2 different banks who said that the SBA does not appear to be processing them in a FIFO or first in, first out order. They seem to be going under some random ordering system. So the banks are a little surprised at the way, you know, they're getting approvals for loans that were for approvals they submitted after, you know, they submitted one after the other and they're getting the second one approved first. The other thing I heard from the banks were that there are some loans where and particularly over 2 million, where the SBA is taking more than the 90 days that they're obligated to render a decision. So that under the normal process, the bank is 60 days, the SBA has 90 days. The SBA is violating that 90-day rule in some cases, and they're not giving a decision quick enough. So that's what we're hearing on the forgiveness front. The other thing, big thing, is a Form 3509, which is for the larger loans. Every loan of 2 million or more seems to be getting the form. The SBA predicted around 42,000 of them would go out. And so these forms ask for a lot of information about the business activity and liquidity of the borrower, both before they got the loan and up to and including the covered period. So these forms do ask for a lot of information, somewhat intrusive, and there's a lot of ambiguous questions in the form. And so we're working with clients to fill these things out and answer both the numerical responses, but also there's qualitative responses too. There are a couple boxes there are a couple thousand character boxes where borrowers can submit explanations for certain items. And so that's where people are really using the opportunity to make their best case and try and get their loan put in a approved bucket rather than a follow-up bucket, where the SBA comes back for seeking more information.
Dan, I just a quick follow-up there. I know, according to that chart before, it looked like a lot of people haven't submitted yet. So
may I ask a question? I know last time we discussed PPP, some banks hadn't released the application for forgiveness yet. Could that still be the case, or
that is still the case? Yes.
Okay.
Some banks still have not opened their portal yet, so that might be the reason. Other than that, we're seeing a difference in psychology. Some people want to get the forgiveness over with, and they want to wrap it up and have certainty, so they apply sooner rather than later. Others are just busy and prioritizing this very low on their list of things to do. So there's no. That part of it's probably the portals aren't open. Part of it's just they haven't gotten around to it yet.
Yeah, the comment I was going to make is that if you haven't submitted yet, we think that most of the restaurants can apply for the easy application, right, Dan? So yep. Keep that in mind that, the easy application would probably work for 99.9% of the restaurants out there. So.
Right. So the easy application, there's no head count or wage reduction calculations. You're just looking at your spending, putting the spending on the one-page form and adding it up and making sure it exceeds the loan amount. So it is a fairly simple process. Gathering the data is the only hard part. On the tax side, in the middle of last month, November 18th, the IRS came out with a revenue ruling and a revenue procedure, 2 documents regarding the PPP loan forgiveness. But basically what the IRS did was they confirmed what they had said back in July in a notice that the expense disallowance will occur in 2020, even if the borrower waits to 2021 to apply, or they don't get a decision until 2021. So as long as the borrower has a reasonable expectation of forgiveness, they would disallow the expenses in 2020. And that's going to be the case for virtually anyone who files a loan forgiveness application. Because reasonable expectation of forgiveness is a somewhat low standard, and if you're filing a loan forgiveness application with your lender under penalties of perjury that you met the criteria for forgiveness and asking for forgiveness, you have a reasonable expectation. I think, and you'd be hard pressed to say that you did not have a reasonable expectation. So in which case expense disallowance occurs in 2020. The revenue procedure then addressed the scenario where let's say you expected full forgiveness on $1 million loan, you disallowed expenses of $1 million. In 2021, you get your decision, and it turns out they only forgave 800,000. So 200,000 was not forgiven, you have to repay. Well, it turns out that you're entitled to 200,000 of deductions, which you disallowed, which you're now entitled to. So the question is, when do you take those deductions? And the revenue procedure says it gives the borrower flexibility and says you can take them in 2020 or in 21 at the election of the borrower. So whichever year is more favorable, the borrower can take those deductions either on an original or amended return for 20 or on a original return for 21. So very favorable IRS guidance in terms of the timing, even though people are very unhappy with the result of expense disallowance. Last thing I'll mention on the PPP, unless there are any questions, is whether this forgiveness expense disallowance will be legislatively overruled by Congress. There seems to be bipartisan support for it. Just comes down to money and whether they have the funds to do this. And it doesn't look like it's making it in. I read the newspaper this morning. They have an even skinnier version of stimulus. I think they're down from 900 billion to 750 billion. This doesn't seem to have made it in, at least in the short summary that I read. This was not one of the items included. So that could change on a moment's notice, but it doesn't appear as if it's going to make it into the next stimulus bill. But again, we won't know until it passes, and anything can happen until the legislation's passed. So with that, I'll open it to questions on the PPP, or move on, whatever you guys think.
Dan, let me ask you real quick on the 3509 form. I've had some clients have some questions and concerns and worries about that form in particular. So if you did, by some odd coincidence, chance, end up having more income after the COVID period than prior to the COVID period, and now they have this 3509 questionnaire that's kind of insinuating, if you will, or suggesting that if your income went up, maybe there's some issue as to whether or not you had a true economic need at the time, I guess, right? So again, most of my clients, when they filled out the form, certainly thought there was a true economic need. And at that time, there really was, whether that played out or not exactly that way. So has there been any feedback from anyone anywhere that this is going to result in this having to be paid back as opposed to being forgivable, or no? What's the?
No, it's still a speculation. So that's a good question. I wrote an article about that last week. It went up on the Withum website, and I used an example of a surgical practice where they were shut down, and so the revenue dropped dramatically. And then after a few months, when they opened surgeries, there was a backlog, and so revenue actually picked up for the year. And so we don't think, and again, this is speculation. I want to stress I'm speculating here, but I don't think that these rules in this form was intended to move the goalposts on borrowers. Because when the SBA publishes rules, they issue interim final rulings, and they publish regulations, and this is not that. This is just a form seeking information. So we think this is going to be used as a filtering mechanism for the SBA to identify what they view as the worst borrowers, right? The ones they want to go after and say you're ineligible for the loan. Even though the information does ask for that, I think it kind of makes sense, right? If you're the SBA and you want to decide who to go after and who to ignore, in order to decide who was reasonable at the time they made their loan forgiveness application, you kind of want to know what happened after the fact, right? How did it work out? It's a logical question. I understand why people don't want to share the information, but if I said to you, here are the borrowers, tell me who you think the worst, who did not have a good faith belief they needed the money. You say, well, let me see what happened afterwards. Let me see what happened to their business. And so just that the reason, if it went up, I don't think that's sufficient to say a borrower didn't have good faith. If you said to me a borrower had, let's take two examples, right? You have a restaurant, or take the surgical practice, right? Things shut down. They were laying off people. They had no work for their employees, including the physicians. And I think you would say they had a good faith belief, right? No one expected that things would recover as quickly as they did. And so they would actually be positive for the year, and exceed 2019. That was unexpected. And I think they had a good faith when they signed the loan forgiveness application. Contrast that with a company that has government contracts and all of their revenue comes from US contracts with the federal government, right? There's no risk of default. These are long-term contracts. They're not going to lose any business, and they're still getting paid. So I think in that case, you would say, well, they didn't really have, there might not be good faith there, because how did they think the revenue was going to drop? How did they think their business was going to be materially altered? And so there are scenarios where you say you might conclude there was not good faith. And we had some clients who returned money in those kinds of scenarios, who got a loan and under the safe harbor returned the money. So you need to look at each borrower and say, what justified their belief that the loan was necessary? And you need to look at the business. What was their cash position? What were the receivables? Was the business shut down? Did social distancing affect them? Were they able to telework? And were the employees able to do the work from home? So there's a lot of factors that go into it. And we think, and again, I'm speculating here, that this form is just a way to give the SBA a full picture on what happened to borrowers, so they can then filter out and go after, ones, and leave some alone and go after. Long answer to a short question, but there you go.
Thanks, Dan. I agree. And I think most of the people on this call, most of your restaurateurs, certainly in New Jersey, are down year over year from prior year. But then you've got those, those quick service restaurants, right? The to-go places that maybe are up a little bit. And, again, back on that day, obviously everybody thought there was going to be an economic necessity for this loan. Most of the restaurateurs, I'm sure, are down year over year. So they're not even concerned about it. And quite a few people are under that $2 million limit anyway. So, okay, I thank you for that.
Can I just ask something to Dan? Dan, what happens if the client, had liquidity and, weren't affected as much due to the COVID-19, and they still got the loan under the PPP? In case of an audit, would they be penalized if they didn't return the money under safe harbor?
Yeah, so the safe harbor period expired, but I guess the answer is there's no answer to that question, because we don't know how much liquidity they think is too much. Okay. Right? There's no standard by which they set. Jake, you okay? No. There's no standard by which they said you had to, if you have X amount of liquidity, X dollars of liquidity, you're not entitled to a loan, or you need a drop in revenue of a certain number. And so there is no objective standard. So they're looking at it's all going to be subjective. Okay. And so I think the liquidity is one factor, but I don't think it will be the dispositive factor. I think you need to look at the full picture, which is what the form really gets at. The form looks at what happened to your business, what happened to your liquidity, and it's not clear how they're going to analyze it. But what is clear to me is I think that this is a filtering device where they can, get a full sense of the particular borrower and say, so they can make then an informed judgment of, again, subjective judgment, whether the loan was necessary.
Okay, thank you.
Good morning. I have a question. Would you expect most restaurants my question is in regards to the safe harbor for the FTE calculation for the reduction. Would you anticipate that most restaurants would fall under that safe harbor, the ones that were shut down, as far as that goes?
Yeah, I think that's what Glenn was saying, that you do the safe harbor on the EZ form. I think most borrowers will fit within that, and they should, because they were shut down during the covered period, I think they can easily make that the representation. I'm looking at it right now on the EZ certification, is the borrower was unable to operate during the covered period at the same level of business activity as before February 15, 2020. I think that's every restaurant in New Jersey. The way the rep is written, it's unclear though, right? What if you have a 24-week covered period and half of it you were closed and half you opened? And let's say you opened and had full, you were able to go back to your full capacity for just assume that for a moment. This rep doesn't require you to be unable to operate during the entire covered period. It just says you're unable to operate during the covered period at some level, at the same level. So we do think that restaurants qualify for this EZ form.
All right, thank you.
All right, good job, Dan. I think I guess we're good then on the PPP side. Certainly, if anyone has any questions after today, feel free to email them to any of us, Dan, myself, Glenn, and we'll help you out with that. You want to move on then to the next step, which we had talked about, some tax planning and some potential tax law changes under a Biden administration. So Alana, why don't you put up the polling question number 3? Kind of launch us into this second part of Dan's presentation. Just trying to get a feel for if we need tax planning for 2020 or not. What ended up happening? I know obviously quite a few of you on the call, and the initial thought would be your income is significantly down year over year, but with the PPP money being taxable income, I've got quite a few clients that now are in a situation where they have as much, if not more, income than 19, and they really do need to do some tax planning at year end.
Again, you can go to menti.com and use the code 7100765. You can either open up on your phone, on a browser, or on your computer. Give it a couple more seconds. Okay, I think we're good, Terry.
Mark needs to find Menti again. If he goes to menti.com on his browser and put in the code, what is the code, Alana? Could you tell him?
7100765. It's also in the chat box too.
Okay, Mark, you got that, hopefully.
Yeah, and it's on top of the screen we're looking at as well, the code. So, okay, it's starting to look like this PPP money didn't truly bail out as many as I was hoping, but I guess we'll give it another 30 seconds and then we'll jump into Dan's presentation. We certainly knew the industry was going to be in a position of significantly lower income than 19, but the thought was that maybe the PPP money would fill that gap. I think obviously it did not fill that gap.
Well, but even with losses, Dan, I'm sure you're going to tell us about some opportunities to carry back and get some refunds for those of you who maybe generated losses, not only significantly lower.
Yeah.
Okay, I'm gonna close it out, Terry.
Yep.
Okay.
Let's hope for a second round of PPP for restaurateurs from the looks of the results there.
Yeah, that was in the paper this morning that the another round of the PPP would be issued, including restaurants.
Yeah, that's the hope.
Yeah, the last bill we saw had it was businesses up to 300 employees, max loan of 2 million instead of 10 million, and possibly a revenue decline of 20 or 25 or 30% would be a requirement to get the second PPP loan.
Okay. Yeah, I think I'm going to imagine we've got a lot of people on this call that'll fit that bill. So yeah, that would be nice. That's really going to be necessary, particularly with the weather coming. Sounds like there's some snow coming in, so a lot of those outdoor tents are going to be a little bit of an issue for the next couple of days at least. So, all right. I think we're good.
I did read an article today that they said that Governor Murphy is not going to, there's no intention of closing down indoor dining like New York, Pennsylvania, Baltimore. So at least, we still have the 25% rule in place. So that's good news. I read that this morning. So
yeah, no, he's told the association he has no plans on closing.
that's good.
Unfortunately, the weather will do away with much of the outdoor dining.
Yeah.
Especially the next couple of days. Dan.
So should we turn to the next topic?
Yes.
Sure.
Great. So You know, with the election, we know Biden won the election. It's now official. It's as official as it can be, I guess. It looks like there's Democrats won the House, the Senate's still up in the air. So that, you know, Biden's proposals are the only ability he'll have to pass them will be if the Democrats win the 2 runoff Senate seats in January 5th. And if Democrats win both of those seats, we'll have a tie in the Senate, which means the vice president will get to break that tie with her vote. So then in that case, the only way Democrats control both houses of Congress if they win both those Senate runoff seats on January 5th. If they do that, then Biden will pass most of his, be able to pass most of the items he talked about during the campaign. If not, you're gonna have a split Congress, and I think there's gonna be very limited appetite for tax increases, if any. So I think that it'll be a much more restricted agenda if they don't win the Senate. And in that case, you'd expect more executive orders and regulatory changes rather than legislation. In terms of tax proposals, you know, Biden would raise the, there were many proposals put forth on the campaign. A lot of them were vague and in various places. We sort of amalgamated a lot of them. But the vagueness stems not from our inability to find it. It's because the candidates put forth vague proposals. I guess there's less of a target on them if they keep them vague. And once you put a policy piece out or document, it's easier for the opposition to target them. So he would raise rates from 37% to 39.6% for people making over 400,000. And this is consistent with his theme that he said he won't raise taxes on the middle class. And so a bunch of his tax increases affect people making over 400,000 a year or over $1 million in case of capital gain we'll talk about. So he would raise the rate from 37 to 39.6 to the highest tax rate. He would eliminate the qualified business income, that Section 199A deduction for pass-through entities or for people making over 400,000. He would phase out itemized deductions for people making over 400,000. And he would also, one of the bigger changes affects people making over $1 million. He would essentially double the capital gains tax rate. The long-term capital gain rate is currently 20%, the maximum rate. He would double it to 39.6%. So it would be taxed as ordinary income. And that would apply to both long-term capital gain and qualified dividend income for taxpayers over $1 million. He would also increase employment taxes for people making over $400,000. And so right now, Social Security wages, the Social Security portion of FICA tax at 6.2% is only applied to the first 137,000 of income in 2020. And he would then say anyone who makes over 400 would also be subject to that 6.2% tax. So that's represents a big increase for people making over 400,000, subject to 6.2% additional tax. On the corporate side, he would raise the corporate tax rate from 21 to 28%. Again, approximately 30% increase. He would do away with some tax benefits, like tightening the opportunity zone regime, which is a favorable investment regime. He would also tighten up the 1031 like-kind exchange rules, possibly only, but there it's not clear if he's going to eliminate it for everyone or just people making over 400,000 a year. He would limit the ability to use real estate losses, and he would increase a bunch of foreign taxes as well. Guilty tax, for example, would double the rate from 10.5% to 21%. Not so much an issue for this crowd on the phone. But when you think about these proposals, it leads to sort of year-end planning ideas, and how do you plan for year-end? Do you take this into account? And the answer is we don't know, right? Because normally at this point in a typical election, we would know the makeup of Congress and we know who won the election. Now we know who the president, we know the House, the Senate's still up in the air. So it's hard to know whether any of Biden's proposals will pass. Again, that really does depend on whether the Democrats can win those 2 Georgia runoff seats on January 5th. So in terms of year-end tax planning, what should people be thinking about? The general rule, absent the election, right? We'll put that aside for the moment. We'll come to that in a moment. The general rule is you want to defer income and accelerate expenses. We know, especially this year, where you have the PPP income is going to be taxable, and that hopefully was expected for people. We've been talking about it for many months now. That's the likely outcome. So hopefully people are planning on that. But if they're not, deferring other income is the way to go. So again, the things we just talked about, like-kind exchanges, opportunity zone investments, are ways to defer some income. If someone has qualified small business stock, they can roll over the gain. There's an exclusion for qualified small business stock of 10 million or greater of 10 times basis. But if there was any other gain can be rolled, if they did not meet the 5-year holding period, they can roll that, and they recognize the gain, you can roll that over under section 1045 into other qualified small business stock and defer the gain. Also contributing to a health savings account is a nice way to get a deduction if you have a high deductible health plan, and installment sales if someone's selling a business. Normally you receive, when you sell a business and receive cash, it would be taxable at that moment in time. But if there's an installment sale, you receive some cash and then payments over time in the form of a note, you can defer some of the gain recognition until those payments are received. On the expense side, the big thing on the expense side is, maybe changes in method of accounting to accelerate some expenses on the business front. Prepaying bills is another way to do that if you're a cash basis taxpayer. On the individual side, most individuals take the standard deduction these days rather than itemizing, because in 2017 the tax law changed, greatly increased the standard deduction. So in order to itemize, you really have to bunch your expenses. So if you normally donate $1,000 a year to a charity, consider donating $3,000 this year and zero for the next 2 years, right? So you bunch them into one taxable year with the hope of having your itemized deductions exceed your standard deduction. So you can bunch them, bunching medical expenses if you had to accelerate a procedure, have it done in 2020, not 21. Obviously you wouldn't undertake a procedure you didn't need, but if you do need one, you might as well accelerate it into a year when you can get a benefit of the deduction. Prepaying mortgage interest, prepaying estimated tax payments. These are some ways, again, to bunch expenses into 1 year so you can jack up your itemized deductions to exceed the standard deduction and get the benefit. I do recall, though, there is the cap for the $10,000 state and local tax limited deduction limitation that does apply for until 2026. So there is limited ability to prepay your state taxes or real estate taxes, et cetera. On if you get into the elections, that's sort of general year-end planning ideas. What do you do with the election, right? And it's hard to plan for something when you still don't know the outcome. And so let me just pause for a moment, see if there are any questions on what we covered so far, and then I'll get into some election year planning ideas. Any questions so far on just general year-end planning? No, okay, so I can keep going. So what do you do with the election year, right? We don't know if these tax increases are going to happen. You don't want to trigger income and then there not be increases, right? That's counterintuitive. So it's hard to really plan. So what we're saying here is, don't do something you wouldn't otherwise do. If you're going to sell something next year, maybe you accelerate it this year on the thought that if the Democrats win, rates will go up substantially, particularly if you're one of those high income taxpayers making more than $1 million a year and you're worried about the long-term rate of long-term capital gain potentially double. So if you want to, what would you do? You would do the opposite of everything we just talked about. Instead of deferring income, you want to accelerate income to trigger it this year while the tax rates are lower than they might otherwise be next year. And again, so there's a lot of speculation here what will happen, but assuming you think rates are going to go up dramatically next year, you'd want to accelerate income this year, and ways to do that, right? If you elect out of bonus depreciation, you might use one way. You just trigger sell assets. You could sell them and buy them right back, by the way. There's no wash. The wash sale rules only apply to losses, not to gain. So you could sell an asset, buy it right back, and trigger the gain this year as opposed to next year. Again, changes of accounting method or other ways to do it. On the similarly, if you're an individual, you could recognize capital gain this year as opposed to next year, selling stocks, buying them right back. Again, there's the same thing. The wash sale rule only applies to securities and losses, that where you recognize a loss, not where you recognize a gain. Some IRA conversions are a great idea. If you want to recognize income this year, convert an IRA to a Roth and pay the tax, this year if you wanted to. Take a required minimum distribution or exercise stock options. The many things you can do that normally would seem counterintuitive might make sense this year if you think rates are going to go up as a result of the Biden's tax proposals.
Dan, if you were a betting man, and I'm pretty sure you are, what do you think is going to happen down in Georgia in January? And maybe this is for Glenn as well, between the two of you. It just looks like a toss-up to me, and I have no idea, and that makes it so difficult from a tax planning standpoint. But Is there any thought or any idea of which direction this might be headed?
I don't have a crystal ball, but it looks, if I had to bet, I would say it could be, I think split is probably, maybe they win one, each party wins one. I mean, the odds certainly favor the Republicans. It's a heavily Republican state, Georgia. But, anything can happen. And they won on the presidential election, they won. So there's a chance the Democrats can win. It really is a toss up.
Yeah,
I know a
I
lot of money is
agree.
being spent there.
I agree with Dan. Yeah, half $500 million already going to be spent. So crazy numbers. I think it's going to be split myself. If I was a betting man, I'd split it. But
Which means none of these new tax laws probably, or very small watered down versions of the changes.
Yeah, there are some small areas where they'll have consensus, like, they'll pass, but it'll be tied to other tax increases to get the Republicans to buy in. Or you may have some moderates, across the aisle for a couple, for adoption credits, stuff like that, to incentivize certain behaviors that everyone agrees are positive. But that would be on the margins.
Such a crazy idea that something that happens in January may very well impact what you should or shouldn't be doing by December 31st. It's a frustrating place to be, but it is what it is.
Yes.
Okay.
Dan, one other question, that $400,000, do we have a clarification as to if it's for individual or merit filing jointly? Is a single filer 400,000?
We don't know. We think it's
Okay.
whatever is on the return. So if it's married filing jointly, 400, or individual 400. But again, this is not laid out in a document somewhere where we can point to. So it's not.
Yeah,
it's not,
I couldn't find it. Okay, that's why I'm trying to clarify there. Okay.
Dan, are you suggesting I need to get a divorce by December 31st?
That's right. I would never suggest that.
No. All right, sorry to interrupt, Dan. You can get back to it.
No, that's it. That's all I had. So that's sort of the year-end planning considerations. Deferral unless you think the Democrats are going to win and the rates are going up, in which case you want to start accelerating.
so Dan, I'm sorry if I missed it. Did we talk about the carry back of the NOL under the CARES Act?
No. So I didn't realize I was talking about year-end considerations.
Yeah, no, I'm just, that's something maybe we should bring up too, is under the CARES Act, the NOL.
Yeah, there's many CARES Act provisions. One of them is the NOL carryback. Losses in 2018, 19, and 20 can be carried back 5 years. So into years you can get a refund. So if you paid tax in going back to 2013, you can have a refund for those taxes paid in that year. So that is a very favorable thing. Hopefully most people are aware of these things by now or heard about it. It's not a year-end play so much as a general play to use losses and to carry them back if you can.
I think the expiration to file that 1139 is December 31st to fax it, to get a quick refund, I think, right?
I don't know the date.
Oh, okay.
Yeah, I've worked on a lot of these. It wasn't an issue then, but they need to be carried back soon, particularly the 18 and 19.
Right.
20 hasn't happened yet, so there's still time to carry 20 back.
Yep.
Right, 20 losses won't crystallize till year end.
So you're saying basically right in March when we file our 2020 tax return, if we did have a pretty bad year and lost some money, we're going to be able to carry that back longer than we typically would have been able to and
Correct.
get refunds of taxes we paid in prior years.
Right, well, the 2017 Jobs Act got rid of the carryback altogether, and so losses can only go forward. But this CARES Act allows you to bring them back for 18, 19, and 20. So 20 would be, when you file in March, you could carry them back to 2015 losses from 20, which is helpful because the rate in 2015 with the maximum corporate rate was 35%. And so there's a benefit. The losses now are only worth 21%. So you're getting it back, can carry it back to a higher rate year.
Gotcha. Yeah, I would imagine that's going to be a pretty big benefit for some folks with 2020 being a rough year. I know we had talked as well about the BAIT, the New Jersey BAIT. You want to kind of touch on that?
Yes, yes. So thank you for reminding me. The New Jersey, so the state and local, the $10,000 state and local tax deduction limitation came in 2017 Jobs Act. And so states that were hard hit by this, notably like California, New York, New Jersey, for example, high tax states, the residents were greatly impacted because state taxes always exceeded $10,000. So they're affected by this limitation. So many states came up with these workarounds to try and avoid this limit, help their residents avoid this limitation and get the benefit of the deduction of their state taxes on their federal return. And so one of them was a charitable deduction workaround where the state let you donate to a charity and get a credit. That one was largely shut down by the IRS last year. Most recently, there have been these entity level taxes on pass-through entities like partnerships and S corps. And New Jersey is one of those states that but allowed for an entity level tax on partnerships and S corps. And it's an elective tax in New Jersey. I think 7 states have passed these entity level taxes. 6 of them are elective. Connecticut's the only one that made it mandatory. And the way it works is let's say a partnership, they would elect to pay tax at the state level. At New Jersey, an entity level tax on the partnership, which did not otherwise exist. And they can then pass through those taxes to the individual partners, and those taxes would not be subject to the $10,000 limitation. So that's the plan. The IRS has blessed this and said it works. They came out a month or 2 ago with a notice saying that, I think 2020-75, if my memory serves, saying that this works and you can pass through these taxes and they'll not be subject to the $10,000 limitation. Some quirks about it are that you have to pay the tax though in 2020 in order for the individual owners to deduct it on the 2020 tax return. So it does have to be paid by the December 31st if you're going to take advantage of the bait. And the other thing though to consider is non-resident partners may be subject to double tax. So it works best in New Jersey if all the partners are subject to New Jersey tax. There may be issues if some partners are resident in other states, with them, getting the credit for the New Jersey tax in their other home state. So that is something to talk to our state and local group if you're in that situation where you have many non-resident partners or shareholders of an S corp.
Right. Yeah, I know I have a client who has 10% ownership out of state. 10% ownership out of state that wouldn't benefit, and they still believe it's well worth doing. When you do the math, even
the benefit to the 90 is greater than the loss to the 10. Is that?
Yes, yeah, that's how the math worked for this particular client. So
are they going to compensate that party in some way for the detriment, the 10% owner?
Yes, and it's become a very complex calculation, but
yeah, right. Contingent one too. So if that partner is subject to double tax, we'll get a distribution from the partnership or something like that.
Right. Yeah, that's kind of the game. That's the idea. Make them whole.
Yep.
It is kind of an unusual, it's kind of almost a circular calculation, right? Because the total dollars paid out, he's not really benefiting from his 10%. Right. So, an additional distribution that then kind of changes the whole distribution calculation. So it's not really very easy to do. So
right.
But it's still worth the dollar savings with the 90%. So
yep.
there is certainly a line, and I wouldn't want to go much past the 10% out of state ownership, it looks like, but
right. Okay. So the thing for people to remember, it is elective. It's optional and elective. And you have to if you're going to do it, you should elect before the end of the year so you can make the payment before the end of the year. Because for federal purposes, the payment has to be made by December 31 in order for it to be deductible in 2020.
Right. Yeah. Basically, if you're an entity, an LLC or an S corp in New Jersey that flows through income on a K1, this is a worthwhile thing to do, right? And it's something that you need to act on soon. So again, if you have any questions, don't hesitate to reach out to us. But it is well worthwhile, and it feels like it's gotten the blessing of the IRS, so it's going to work even going forward. So it makes sense.
Yeah, it was surprising they blessed this. They shot down the charitable deduction one, but they blessed this one. So, I imagine more states will pass something similar now that it's, been approved by the IRS.
Yeah, I agree. Does anybody have any questions, anything at all tax related to either this year end or going forward in the future? No, Dan, anything else going on? Anything else interesting in the tax world these days, or we'll wrap it up a little early?
That's it. You know, the CARES Act is a big thing. A lot of that was, you know, it's news people are aware of at this point. But there were many changes in the CARES Act. Now the PPP is a big thing, getting those applications in. So we're spending a lot of time on that, preparing and reviewing applications to submit them. And it's just year-end planning, a lot of M&A. We're seeing a bunch of activity going on, people selling businesses, not so much the plan for tax increases, just they want to, you know, selling their business. And the COVID didn't impact the sale, which is nice to see that it's not, you know, valuations haven't dropped dramatically.
That's good to see. Let's hope these vaccines that are out there and starting to become available kind of turn this whole thing around. And my hope is, knock on wood, by the summer, restaurants will be 100% occupied. That would be my hope. Now, don't take it from me, but I would love to, in the summer, go to a couple of the nicer places on the shore and sit there and have a drink and see the place full, back to the rafters. Let's hope for that.
I think I heard something from Fauci that said maybe third, fourth quarter, things would be back to normal. So that could very well be restaurants are filling up.
Does that get me in the summer? I just want to be sitting in the summer by the beach, Dan, not third, fourth quarter. Stop.
You'll be there.
Someone wants to see something very funny. There's someone did a skit, Fauci on a couchy. And you know, you've heard of like Elf on a Shelf, that kind of thing. That's very funny.
He's pretty much put us all on the shelf.
Yeah, he did.
Well,
Yep.
not him, COVID-19, let's be fair. Well, I would like to definitely thank you, Glenn, Terry, and Dan, for giving a wonderful roundtable, and of course, Alana. And Jacob, who's the unofficial, I guess, member of the team, right? Well, not unofficial, but a roundtable panel. Thank you, and have a wonderful day and a happy holiday.
Thank you.
Thank you all.
Thank you all.
Thank you.
Thanks so much.